So hello everyone, how are you all? I welcome you all to the another lecture on our RRB batch for the May 22 students, right? So as you all know that we have already completed a company audit and we have also started with the introduction of the professional ethics with the NOCLAR and along with the summary of the new code of ethics 2020. Now I'm going to make you understand another very small chapter, like the remaining professional ethics, we'll do it later on, but I would like to make you understand another very small chapter that is called audit of consolidated financial statements. So as you can see that in front of you, there is an audit of consolidated financial statement. Very important chapter, everyone. And you can expect a minimum 4 marks going to come from this particular chapter. And there are so many aspects to be covered in the audit of consolidated financial statement. First of all, let us understand, sir, what do you mean by consolidated financial statement? You all know that consolidated financial statement is basically a prime responsibility of the parent company. It is a responsibility of the which company? Parent company, to ensure that consolidated financial statements are prepared. Now, when we talk about the consolidated financial statements are like standalone financial statements only. So as I was saying, consolidated financial statements are like normal standalone financial statements only. It's just that the word standalone will be substituted with the word called consolidated. Now you can see that what do you mean by consolidated financial statement, as it is the parent company's responsibility that it should consolidate the financial statement of all its components with itself. That is called its subsidiary, joint venture and associates. Now, when we talk about the consolidated financial statement, these are four in number: consolidated balance sheet, consolidated P&L account, consolidated cash flow statement, and consolidated statement of changes in equity. As per section number 129, we know that there are 5 financial statements: balance sheet, P&L, cash flow statement, notes to account, and statement of changes in equity. It is just that we have to include one word called consolidated before the name. Now, next thing what we have to understand, in the audit of consolidated financial statement, you have to understand one very important fact that when we talk about the companies today in India, some companies follow accounting standards in India, and some companies in India today follow the IND-AS, right? Now, as you all know that IND-AS came into India in the year 2015. So some companies are still following accounting standards, some companies are following IND-AS. So those companies which are following the accounting standards, they have to use the division 1 format of schedule 3 while preparing their consolidated financial statement. Again repeating, division 1 division 1 format of schedule 3 while preparing their financial statement. And if you are a company which is using the IND-AS for preparation of their financial statement, for them division 2 of the schedule 3 requirement is required. Next thing, now what is that section number 129 subsection 3 of the Companies Act 2013 says that now what used to happen earlier, that when the parent company's AGM will come, annual general meeting will come, the parent company used to put its own standalone financial statements, consolidated financial statements of the group. But now the recent amendment says that own standalone financial statement of the parent is required, plus consolidated financial statements of the group is required, plus standalone financial statements of the component. What do you mean by component? Subsidiary, associate, and joint venture is also going to be laid down in the same AGM. Sir, what is the reason why holding company, why parent company has to do that? The reason is very simple, everyone. Try to understand how a investor will come to know that which subsidiary or associate or a joint venture is a profit making and which one is loss making. They can only come to know that when they will see the standalone financial statements of joint venture, associate, as well as the subsidiary. So section number 129 subsection 3 says that every parent company along with its financial statement shall also prepare the consolidated financial statements of its components, and along with the consolidated financial statement of its components, standalone financial statement of component is also the parent's responsibility. Clear, everyone? Yes, sir. Next, what is section number 129 subsection 4 says? Now, section number 129 subsection 4 is very simply saying one thing, key, if the standalone financial statements are getting prepared as per section number 129, the audit rules, preparation rules, and the adoption rules. Again repeating, audit rules, preparation rules, and adoption rules, which are applicable to the standalone financial statements, are equally applicable to the consolidated financial statement. So there is no separate rules for the consolidated financial statement. What is applicable to the standalone financial statement? What are the audit rules applicable? What are the adoption rules applicable? What are the preparation rules applicable to standalone financial statements are equally applicable to the consolidated financial statement. And not only that, nowadays I just now told you, as per section number 129 subsection 3, holding company's responsibility is not to prepare its own standalone financial statement, not to prepare only the consolidated financial statement, but also to let down the standalone financial statement of its components. When I'm using the word called component means what? Component means subsidiaries, associates and joint ventures in the form number AOC1. So you can see it right over here in the form number AOC1. It is required to be attached here. Clear, everyone? So this is what brings an end to the introduction of cash flow statement, section number 129 subsection 3 and section number 129 subsection 4. Now, as this point, if you remember, this point we have already discussed. This point we have already discussed in our company audit topic. Now let me tell you where we have discussed it. Company audit mein, if you remember, section number 129 of the Companies Act, that is financial statements of the Companies Act, we have understood. In that I told you that let's say for example there is one A company is holding 100% of the voting rights in B company, and the B company is holding 80% of the voting rights in C company. Now you all know that A is also a parent company, B is also a parent company. It means B also has to do the consolidation. But Companies Act section number 129 says that B is a which subsidiary now? B is a intermediate wholly owned subsidiary. Again, I'm saying B is a which subsidiary? Wholly owned subsidiary, because A is holding how much in the B? 100% in the B. So consolidation of B plus C. Again repeating, consolidation of B plus C, which is the responsibility of the B, is not required to be done by the B. It will be the responsibility of whom? A. Why the parent will take the responsibility? Two conditions will be satisfied. Then in that case, B will get the exemption. Sir, what are the two conditions to be satisfied? Condition number one, the B is neither a listed company nor a listed company in India or outside India, or nor in the process of being a listed company. Condition number one. Condition number two, its immediate parent company. Who is the immediate parent company of the B? Its immediate parent company A must be located in India. So if you are a wholly owned subsidiary, you can get the exemption from the consolidation. Two conditions: if your immediate parent company is located in India, and most importantly, if you are not a listed company or going to be listed company in India or outside India. Now, sir, is this same exemption available to the partially owned subsidiary? Answer is yes. Same exemption is available to the partially owned subsidiary, but instead of two conditions, now three conditions to be satisfied. So what are the three conditions? Condition number one, immediate parent company should be located in India. So same condition, yes. Condition number two. Condition number two says that in case you are not a listed company in India, outside India, or not in the process of being a listed company. Okay, sir, that also we understood. So in case your parent company is immediate parent company in India, immediate parent company is located in India, or you are neither a listed company nor going to be listed company in India or outside India. And the third condition is you have to send a written notification to your non-holding members. What is a written notification to your non-holding members? You have to send that, do you have any objection if I do not make the consolidation? Now the question is, who is sending this? Let's say for example, A is holding 80% of the voting rights in B now, and B is holding 60% of the voting rights in C now. Now you can see that B also has to do the consolidation of B plus C. But remember, B is not required to do the consolidation if the immediate parent A is located in India. Now what is B? Is B a wholly owned subsidiary? Answer is no. B is not a wholly owned subsidiary. B is a which subsidiary? B is a normal subsidiary, partially owned subsidiary. But what is the third condition? Now tell me, how much A is holding in B? A was holding 80% of the voting rights in B. Now you can see that. What about the remaining 20%? Remaining 20% are non-holding interest. So what the B will do? B will take the permission from the non-holding interest. Do you have any objection if I do not give you the consolidated financial statement? If the non-holding interest give the permission, then in that case B has to do, or B need not do? B need not do any kind of consolidation. Did you get the point? So yes, we have already covered that in section number 129 in the company audit. If you want to read it again, you can refer to the 129 company audit chapter again. Next, most important thing you have to understand that when we do the audit of consolidated financial statement, there are some definitions which are being changed as per AS and as per INDS. So when we talk about the definition of the control, when we talk about the definition of associate, subsidiary, joint venture, minority interest, so there are some words which are having a different meaning in the INDS and having a different meaning in accounting standard. Now look at the first definition, associate. You all know that what do you mean by an associate? A company in which the another company is having a significant influence. And what do you mean by significant influence? At least 20% of the voting rights. But associate name or associate meaning as per the AS and as per INDS is same. You can see that there is no change. Next thing, what do you mean by control? The control means what? Control means directly or indirectly another company is having a control over more than 50% of your equity, as well as the another company is having more than 50% of the control over your composition of the management. That is generally we see when we talk about the holding company. But here, instead of using the holding and subsidiary, they have started using the word called investor investee in INDS. Now, what is the definition of the control? Same definition only the words have changed. Now, what is the word? When an investor has rights over the investee. Who is investor? Holding company. Rights over the investee, holding company, and has ability to affect the returns throughout its power over an investing. It means it has a right to exercise its power over an investing. The same thing we are talking in AS and in INDS, just that the words have been changed. Instead of holding subsidiary, we have now started calling them investor investee company. Clear everyone? Next one. Sir, what do you mean by joint control and joint venture? You know that joint control and joint venture is an arrangement between the two companies where they will be having the joint control over the same project. It does not have any different meaning in INDS. It is same. Next one. What do you mean by minority interest? You all know that what do you mean by minority interest? The interest which is other than the holding interest. Let's say, for example, A is holding 80% in B. 80% is held by the A. But what about the remaining 20%? 20% is held by A? No, it is not held by A. It is held by another company. Are you getting the point? It is held by another company. No, it is not held by another company. These are those 20% people who are called as a minority interest. They are called as which interest? Minority interest. And in your financial reporting paper, we already know that some portion of the minority interest we calculate, that is the net assets attributable to them, net results attributable to them. So that is as per the accounting standard. But the same thing when we see under the what do you say INDS, instead of minority interest, we are going to call them as non-controlling interest. We are going to call them as which interest? Non-controlling interest, in which instead of calling it as net results and net assets, we are going to call it as equity. So remember, we call it as net results and net assets attributable to minority interest in case of AS. We call it as net equity attributable to minority interest in case of what? INDS. Next one, subsidiary definition is same, which is there in the AS. It is also equally applicable in the INDS, right or not? So this is what the introduction of this chapter called Audit of Consolidated Financial Statements. Next thing, what is the parent's responsibility when it comes to the audit of consolidated financial statement? As you all know that consolidated financial statements preparation and presentation is whose responsibility? Parent's responsibility. So it is a parent who has to take care or ensure that the preparation and presentation of consolidated financial statement should take place. Next point which we have to understand is now next point which we have to understand is you have to ensure that when the parent is making the preparation and presentation of financial statement, there are other few responsibilities of the parent company you have to understand. What are the other few responsibilities of the parent company? It has to identify its components and include their financial information in the consolidated financial statement. So suppose I'm a parent company, my responsibility is to identify my subsidiaries, associates and joint ventures and include their financial information in the consolidated financial statement. Now, what is the next responsibility the parent has? It also has to identify its reportable segments. As you all know that what is reportable, not reportable as per AS 17. That is the parent's responsibility to identify its reportable segment. It is also the parent's responsibility to identify its related party and related party transactions. So total four responsibilities of the parent. We have done that. Parent is primarily responsible for the presentation and preparation of consolidated financial statement. Parent is also responsible for identifying its components and including their financial information in the consolidated financial statement. Parent is also responsible for identifying its reportable segments. Parent is also responsible for identifying the related party and related party transaction. And remember, parent is also responsible for obtaining accurate and complete information. So remember, parent has to ensure that whatever the financial information it is adding in the consolidated financial statement, it should be accurate and complete. And it is a parent's responsibility to do the consolidation adjustment. Sometimes the accounting policies of the component and the accounting policies of the parent are not matching. So who has to do the harmonization of those accounting policies? That is also parent's responsibility. Sometimes the gap of the parent, that is generally accepted accounting principles of the parent, are not matching with the generally accepted accounting principles of the components. Then it is the parent's responsibility to ensure that those gap also should be harmonized or changed accordingly. So there are total 7-8 responsibilities of the parent: preparation and presentation of consolidated financial statement, identification of the components and including their financial information, make sure that the information which is it is including should be accurate and complete, identification of the reportable segments, identification of the related parties and related party transactions, identification of carrying out the consolidation adjustment, harmonization of accounting policies, and conversion of the gap if required. So these are whose responsibilities, everyone? These are parent company's responsibility, because consolidation is the responsibility of which company? Parent company. Now, next thing, auditor's responsibility. Now, what is the auditor's responsibility? Parent auditor's responsibility is what? CFS, Consolidated Financial Statement Auditor responsibility is what? He has no different responsibilities. He has the same responsibilities which we generally take place in the standalone financial statement. Tell me one thing. Do we have to check in the standalone financial statement whether the financial statements are prepared as per the applicable financial reporting framework or not? Sir, answer is yes. Same thing he is doing it here. He has to check that consolidated financial statement must be prepared as per AFRF. Do we check in the SFS, standalone financial statement, to express an opinion on the truthness and fairness of the financial statement or not? Yes, he is expressing the opinion on the truthness and fairness of what? Consolidated financial statement. We also have to ensure that we have a duty to inquire under section 143 subsection 1. Do you remember that in the company audit we have done the 6 topics? Same auditor's responsibility is case of consolidated financial statement, and whatever the auditor's responsibility in case of reporting on certain matters under section 143 subsection 3. Do you remember the J clauses? And in the J clause amendment has come. Same responsibility auditor is having when it comes to 143 subsection 3. So when the auditor is doing the audit of consolidated financial statement, we cannot say that auditor's responsibility differs just because he is an auditor of consolidated financial statement. Answer is no. His AFRF checking will remain same, expression of opinion will remain same, duty to inquire under 143 subsection 1 will remain same, duty to report under 143 subsection 3 will also remain same. Next point. In the CFS audit also we have to do the audit planning. Why the auditor does the audit planning in the SFS audit? So that he can complete his audit on timely, efficiently, and effectively based. Same is the case here. When the auditor is doing the audit of consolidated financial statement, he has to ensure that he should do the adequate planning, strategy, and programming so that he can complete the consolidated financial statements on timely basis, effectively and efficiently. Audit can be done on time. So this is what SA 300. Now, in the standalone financial statement, do we acquire the knowledge of internal control system and accounting system of the client? Same way, auditor has to acquire the knowledge of internal control system and accounting system of the consolidated financial statement or total group, so that he can understand internal control system, accounting system, general IT control system, so that he can decide his nature, timing, and extent of his which procedure? audit procedure. So we are not doing anything different here. Same thing which you do as a statutory auditor of a standalone financial statement, same way you have to do the audit of consolidated financial statement. Clear everyone? Next one. In the normal general audit of standalone financial statement, we have to check the audit risk or ROMM applicable in the financial statement, and we would like to proceed with our procedures, RAP procedures, so that we can bring down the ROMM to the lowest acceptable level. Same thing as a 315 ka ROMM level. Now you have to check not in the standalone financial statement, you have to check the same ROMM level at the consolidated financial statement level. Next point, we have to ensure that what rules and regulations are applicable to standalone financial statement are equally applicable to consolidated financial statement. And most important thing, most important thing, tell me one thing, is it necessary that the parent auditor is also the auditor of the subsidiaries? Answer is no. If the parent auditor is also the auditor of the subsidiaries, associates and joint ventures, then so there is no requirement of SA 600. What is SA 600, everyone? SA 600 is all about what? It is all about using the work of another auditor. So tell me, if the component auditor and the parent auditor both are same, do we need to consider SA 600? No. But if the parent auditor thinks that I can do the consolidated financial statement alone, I do not need any kind of coordination with the other auditors, then in that case, there is no need to comply SA 600. But if the parent auditor or the CFS auditor thinks that he himself alone cannot do the CFS audit alone, he has to take care of the help of another auditors of the components, then in that case there will be a compliance of SA 600. So there is nothing extra, nothing extraordinary we are doing. Generally what we do at the standalone financial statement, same procedure we are following when we are doing the consolidated financial statement. And most importantly, generally we take WRL from the management when if management is responsible for the preparation and presentation of financial statement. Management is responsible that financial statements are prepared as per AFRF. Management is responsible that material considerations have been taken care of while preparing the FRF. Standalone financial statement. Instead of standalone financial statement, we have to use the consolidated financial statement. So here also auditor under SA 580 is taking the WRL from the parent company with 3 declaration. CFS are prepared as per AFRF, same point. They approve CFS and take responsibility of its preparation, same point. They consider all the material matters which think they are material for the preparation of CFS preparation. So instead of SFS, we have to substitute a word SFS with what? CFS. Next one. Very important point. Now you have to concentrate very importantly here. Now try to understand which I'm trying to tell you in the next 2 minutes. Now see. What do you understand by materiality level? Every auditor has to check the materiality level of the ROMM and financial statements which might be affecting the users of financial statement. Am I correct? If you are a parent auditor, you will be having your own materiality level. But if you are a component auditor, you are having your own materiality level. Remember one thing, materiality level is a relative concept which keeps on changing from person to person, judgment to judgment, auditor to auditor, case to case, entity to entity, year to year, circumstance to circumstance. Make sure that when the materiality level you are considering, you are not supposed to force the component auditor's materiality to be dropped down, and they should not be forced to follow your materiality level. Just because you are a parent company auditor or just because you are a CFS auditor, it doesn't mean that component auditors do not have their individuality. You are not allowed to challenge their competency if they have already considered or if they have already made their own materiality level. It is your responsibility that while drafting the consolidated audit report, you have to take their materiality level as it is. You are not allowed to do any kind of changes in their materiality level. Say, for example, there is one subsidiary auditor. He has kept his own materiality level, due to which he has given a modified or qualified report. Even though that subsidiary is ignorable in nature, but as a CFS auditor, you are not going to ignore that subsidiary just because it is ignorable in size. The materiality level of that component auditor which he used for modifying and keeping the reservations in the audit report, you have to take it as it is. You are not allowed to alter the materiality level of the component auditor just because they are smaller than you. Are you getting my point? The materiality point of level pay, the subsidiary auditors may have their own point of view, you may have your own point of view, no one is challenging yours, and parent auditor, the CFS auditor, is also not allowed to challenge theirs. That is what the 320 special point you have to mention. Is it clear, everyone? Yes or no? Yes. Now, what is the next point? The next point you have to understand what is the other financial information the auditor is responsible for. Auditor has to look for there is a proper harmonization of accounting policies done by the parent company. There's a proper conversion of gap done by the parent company. Let me tell you one thing. When the accounting policies of the component are not matching with the accounting policies of the parent, components have to change according to the parent. Parent will not change according to the components. So remember, child is going to change according to the parent. Parent is not going to change according to the child. Are you getting the point? When the conversion of gap is also taking place, components gap should be changed as per the parent, not the parent's gap should be changed as per the component. And same thing applies with the consolidation adjustment also. Consolidation adjustment is also whose primary responsibility? It is a primary responsibility of the parent, and sometimes subsequent event adjustments will come. Sir, how? Let me tell you one thing. Suppose A is the parent company. Its financial year is starting from 1st April to 31st March. B is the component company. Its financial year is starting from 1st June to 31st May. Now tell me, is the financial year of the parent company and the component company same? Answer is no. Any event took place in the month of April is going to be a subsequent event for company A, but it is a in-year event for company B. Again, I'm saying, suppose any event took place in the month of April, it is a subsequent event for company A, but it is an in-year event for company B. Why? Because company B's financial year gets over on 31st May, whereas the company A's financial year gets over on 31st March. So for the 31st March ending company, April month event will be a subsequent event, whereas for the company which is ending on 31st May, for them it is going to be a in-year comment. So auditor has to take care of all these things. Next most important point, audit the consolidation. Now it is the high time that auditor should start auditing the consolidation. Now it's very important point you all have to understand. Whenever auditor does the audit of consolidation, he has to first understand the importance, or first understand the group structure. How many associates are there? How many joint ventures are there? How many subsidiaries are there? Second thing, he has to understand the group controls, not individual, because he is an auditor of CFS, so has to make sure that he should understand the group structure. At the same point of time, he has to make sure that he understands the group control. Now, what do you mean by group control? What are the information technology controls, general IT controls, IT dependent controls? What are the application controls? How many are manual? How many are automated in the total group? He has to also ensure the nature, timing, and extent of his audit procedure on the basis of ROMUM in the CFS. You all know that while doing the consolidation, there's the high risk of material misstatement. So on the basis of that, it is the auditor's responsibility to determine his nature, timing, and extent of his audit procedure. It is the auditor's responsibility to understand the accounting policies of not only parent, he also has to understand the accounting policies of the component, because he will be watching how the parent company does the harmonization of the both. As a CFS auditor, it is also your responsibility to understand the translation process. Sir, what do you mean by translation process? Now try to understand. When the foreign subsidiary or the foreign associate is going to be translated into Indian currency to be merged or consolidated with the Indian parent, then there will be a translation process to convert the foreign currency into an Indian currency. Who has to take care of that? Auditor has to take care of that. He should understand. So what the auditor should understand? Group structure, group controls, accounting policies of parent as well as the holding parent as well as the component, translation process, determining the nature, timing, and extent of his audit procedures on the basis of ROMUM at the time of consolidation. And most important thing, he has to check whether he is in looking for any use of another auditor's work. If yes, how he is going to coordinate the work. This is how you do have the responsibility when the consolidation is going to take place. This is how you do the audit of consolidation. Next point. Completeness of components. It's a very, 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 very important topic. Now try to understand, sometimes the parent company does not realize the fact that even though intentionally it is not becoming, but unintentionally sometimes it becomes a parent of some components. Let's say, for example, Reliance Industries was watching Infosys Limited. Suppose Infosys Limited was giving a high amount of profit in the market. What Reliance Industries did? Reliance Industries was watching the share price of the Infosys. So Reliance Industries first bought 10% of the share capital. Then it bought 15%. Then it bought another 6%. So 15 plus 6% makes it toward 21%. But Reliance did not realize that the Infosys became its associate. Are you understanding my point? So sometimes you do not know that you became a parent and somebody became your component, either intentionally or unintentionally. I can say that it can be a genuine case or it can be intentional case also. In such cases, what to do? In such cases, auditor should take the total list of components from the management. Auditor shall obtain the total list of components from the parent company. After obtaining the total list of components from the parent company, he should watch the parent company very carefully, how the parent company is doing the consolidation of all those components, whether all those components are included or not. In case auditor feels suspicion that if the list provided by the management or the TCWG is not the complete list, then how he is going to do the completion of that components? This is what is this question. We have total 7 to 8 tools in our hand by which we can do this incomplete list turn into a complete list. Now, tool number 1. What is the first thing we are going to understand? Tool number 1. You all know that as per SA 230, do we maintain our audit working papers? Yes, we do maintain our audit working papers. As per SA 230, we have to preserve it for 7 years. I'll immediately go to my office. We'll review my audit working papers of the past year. I'll come to know that how many components were there in the last year. Tool number 1. Tool number 2. I will directly go to the management and inquire how many components you have included in the consolidation and how many components you have excluded in the consolidation. If you have included, that is very well, but if you have excluded, why? So this is what the point number 1. Point number 2, I am telling you. The third thing is I will identify or I will check the management's method of identification of the components. How management identifies that something is a component or not, I'm going to check their method also. Next, I'm going to check their investment register. Sir, what you will come to know from the investment register? Bhaiya, from the investment register, I'll come to know that whether the company has invested in that company to make it as its associate or to make it as its subsidiary or to make it in a case of joint venture. So from the investment register only, I'll come to know that if 20% to 50% investment the parent is having in one company, it means that company is associate. More than 50% subsidiary. If there is a joint control, that is a joint venture. That is a fourth method. Then I will also check their joint venture and joint arrangement papers and I will verify them right from the bottom to the end so that I'll come to know that who are joint ventures, where they have entered into a contract. I will also verify their other arrangements or other documents which I have not included, but maybe they might have forgot to include it. I will check it and verify it. And most importantly, I will tell the management, please give me your 186 and 189 register. 186 intercorporate loan register, 189 register of related party loans. From that also I'll come to know whether the components list is correct or not. And last but not the least, identify the changes in the which pattern? Holding pattern. So there are total 8 methods available with the auditor by which he can accomplish the objective of completeness of components. If he thinks that the components are not properly included, he can immediately on the spot, he can come across this. Did you get the point or not? Yes. Next point. Next thing what we have to understand here is, sir, you just said in the point number 2, is some components might be included, some components might be excluded. Yes, I said. On what basis the company can exclude its components? Remember one thing, if the company is following accounting standards, there are 2 types of components which the company can exclude from the consolidation. How many types of components, everyone? 2 types of components. So what are the 2 types of components? Components number 1, with whom the parent company and the component relationship is temporary in nature. Let's say, for example, I bought some 25% of the shares in one company. Now tell me, that company became my associate or not? Yes. But I did not buy it from the associate point of view. I bought it to sell it in the near future to get the maximum profit out of it. So tell me, was it an investment purpose or was it a trading purpose? It was a trading purpose, short-term purpose. So here the parent and the component relationship was what? Permanent? No, it was temporary. Such components are not required to be included in the consolidation. That is what the point number 1. If the company is following what? Accounting standards. If the company is following accounting standard, there are second set of components also not required. Those components are not required where there is a severe restriction. Those components are not allowed where there is a long-term severe restrictions is there on the components which impairs their right to transfer the funds to the parent. Means what? You are a subsidiary. On you, there is a long-term severe restriction that you are not allowed to transfer the funds back to the holding. Even though you want to give the funds back to the holding, ki bhaiya, I don't want your funds, but there is a long-term severe restriction on the component which impairs the right to transfer their funds back to the holding company. If you are a company following accounting standard, these are the 2 types of consolidations which are not allowed to you. These are the 2 types of components which are not required to be included for the purpose of consolidation. If you are a company following INDAS, in generally INDAS, you are not allowed such kind of exclusion. INDAS says that all companies are required to be included. All company, whether temporary relationship, long-term severe restriction, it matters or does not matter? It does not matter at all. Did you understand the point? It does not matter at all. But recently what has been told that if you are a company following the INDAS, there are some sort of what do you say components which can be excluded. Sir, which kind of components can be included? Those components, those subsidiaries which I only made or acquired for investment purposes. It means those subsidiaries ka nature is what? The nature of those subsidiaries are investment subsidiaries. Those are which kind of subsidiaries? Investment subsidiaries. Those investment subsidiaries are not required to be added in what? They are not required to be added in the not required to be added in the consolidation, but that is only available if it is the company following INDAS. If it is the company following AS, then 2: short-term relationship, temporary, and long-term severe restriction on the subsidiary. On the other side, if the company is following INDAS, which are excluded from the consolidation, which are what? Which are only and only investment purpose related subsidiaries. Next most important thing, consolidations to be done on line to line basis. Remember one thing, if you are a company following accounting standard, your consolidation must be as per AS 21, AS 23, AS 27. But if you are a company following INDAS, your consolidation must be as per 110 INDAS, INDAS 103, INDAS 111, INDAS 28. So what are the 4 standards which are applicable for consolidation when you are doing the consolidation as per INDAS. INDAS 110, INDAS 111, INDAS 103, INDAS 28. But if you're a company following accounting standards, you have to do line to line consolidation by following AS 21, 23, 27. And remember, your assets, liabilities, income, expenditure, and cash flows should be line to line added with each other. You also have to calculate the goodwill and capital reserve. As you all know that when do we calculate the goodwill? When we end up paying more than what is required to be paid, and when we end up paying less than what is required to be paid, in that case it results into capital reserve. And attribution of the equity towards the minority interest. So if you are a company following accounting standards, you have to follow the consolidation rules of AS 21, 23, 27. But if you are a company using INDS, you have to follow 110, 111, 103 and 28. The list is given in front of you. Is it clear, everyone? Yes. Now the most important part. Sir, what is the most important part? After this, our particular topic on the audit of consolidated financial statement will be over. Remember, every company has to do, every parent has to do two types of consolidation adjustments. What are the two types of consolidation adjustments? One is known as permanent consolidation adjustment and one is known as temporary consolidation adjustment. Permanent consolidation adjustments are those adjustments which are only required to be done once, that too in the first year. It is not required to be done at the later stage. But at the subsequent years, if there is a change in the shareholding pattern, then this adjustment may come again. Remember, 99.99% of the cases, permanent consolidation adjustments are only required to be done at the first occasion, not at the subsequent occasions. But in the subsequent occasions, it might be required if the shareholding pattern changes. Point number one. Now, question is, sir, what are those permanent consolidation adjustments? There are two permanent consolidation adjustments. One is the calculation of goodwill and capital reserve. What is the first one? Calculation of goodwill and capital reserve. The another one is determination of equity. What is another one? Determination of equity attributable to the minority interest. These are the two permanent consolidation adjustments which are only and only required to be done at the first occasion. Otherwise, it is not required to be done. But yes, equity movement towards the minority interest may keep on changing on yearly basis. That might be the thing which you have to calculate it again and again in the coming years. But calculation of goodwill and capital reserve is only required to be done one. That's why it is known as which one? These are known as permanent consolidation adjustments. Is it clear, everyone? So, when the permanent consolidation adjustments are happening, what are the 6 audit procedures of an auditor? As a CFS auditor, you are sitting on the right side. You can see that audit is sitting on the right side. Auditor is sitting on the right side watching the company doing the permanent consolidation adjustments. So when the company is doing the permanent consolidation adjustment, point number one, what he is checking? Calculation of the goodwill and calculation of the capital reserve which the company has carried out under the permanent consolidation adjustment is appropriate or not. Duty number one. Procedure number two, he has to have a major focus, main focus of the auditor should be on the pre-acquisition reserves, because pre-acquisition reserves are required to be distributed among holding interest and non-holding interest in a very appropriate manner. Remember one thing, biggest of the frauds of the companies takes place in the which one? In the pre-acquisition reserves. Pre-acquisition reserves must be contributed or must be apportioned between minority interest and holding interest in a very appropriate manner. That is the third procedure of an auditor. Fourth procedure of an auditor, he should always look for the dates of investment. Whenever the investments are increasing or decreasing, when the parent company is doing the investments in its components, each and every date he shall make a record of. Next important point, he should monitor the changes due to subsequent acquisition or subsequent disposal. Say for example, there was one company which was my associate with 35% voting rights, but company increased 35% to 55%, not 20% increase. It means from associate it changed into subsidiary due to more acquisition or more disposal, more acquisition. Suppose it was a subsidiary with 65% of the voting rights, but company recently disposed 35% out of 65%. It means from subsidiary, it changed to what? Associate. So it means monitor the changes due to the subsequent acquisition and disposal of components in the group. And most importantly, most importantly, now say for example, it is the parent's company's responsibility how they want to show the goodwill or capital reserve. See, let's say for example, for all the components, company paid the goodwill of 2500 crores. And for all the components, company earned the capital reserve of 600 crores. Goodwill you have paid 2500 crores and capital reserve you have earned is 600 crores. Now tell me, capital reserve will come on the liability side 600, goodwill will come on the asset side, that is 2500. Now what is the net effect? 1900. So it is a parent company's choice whether it wants to show 1900 consolidated effect, set of effect, or it want to show 2500 separately and 600 capital reserve separately. So it is purely parent company's responsibility how they want to show. So these are my 6 audit procedures to be taken care of when I'm doing the audit of permanent consolidation adjustments. Now, what do you mean by current consolidation adjustment? What is the next topic? Current consolidation adjustment. Sir, current consolidation adjustment means those consolidation adjustments which are required to be done only once or every year. It is required to be done every year. So what do you mean by those kind of adjustments? Intra-group indebtednesses and intra-group balances, intra-group interest payments, intra-group interest received, intra-group management fees received, intra-group management fee paid, intra-group indebtedness, intra-group profits from the sale of property by the component to the parent or by the parent to the component, harmonization of accounting policies adjustments, conversion of the gap adjustments, then subsequent events adjustment if in case the component and the parent have the same financial year, in case the component and parent have the different financial year, and deferred tax payments. You all know double tax, deferred tax asset or deferred tax liability, which may come arising of temporary differences and movement in the equity. Sometimes move more towards the minority, sometimes less towards the minority. So movement in the equity attributable to minority interest and non-controlling interest. Again, what do you mean by current period consolidation adjustment? Those adjustments which the parent company has to do on yearly basis every year. It's not like permanent. Permanent is only required to be done at the first occasion, but this is required to be done on yearly basis. Point number 1. What is yearly basis adjustment number 1? What is yearly basis adjustment number 1? Adjustment number 1 is what? Intra group indebtedness, intergroup interest payment, intra-group interest received, intra-group management fee paid, intra-group management fee received, intra-group profits on sale of property from component to parent, parent to component, intra-group harmonization of accounting policies, conversion of the gaps, subsequent events if the holding and parent and components are having the same accounting year, subsequent events if the parent and component are having the different accounting years, deferred tax payments arising on the temporary differences, and movement in the equity attributable towards minority interest and non-controlling interest. Clear, everyone? Now, sir, this is the procedure you have to check. Like in the permanent consolidation, we have checked the procedure. Here also you have to check the procedure, but I will make it very easy for you. You just have to remember the current year or temporary consolidation adjustment. Prefix every temporary consolidation adjustment which you have in mind with the words check that. So what the auditor has to check that? Auditor has to check the memorandum accounts. Auditor has to check that inter-debt, intra-indebtedness is eliminated. Auditor has to check that intra-interest payments are eliminated. Auditor has to check that management fee payments and receipts are eliminated. Auditor has to check that intra profits are eliminated. Auditor has to check that harmonization of the accounting policies have taken place. Auditor has to ensure the uniformity in the accounting policies. Auditor also has to check that there are some accounting policies which cannot be harmonized. See, there are some accounting policies which are impracticable to be harmonized. Leave it as it is. Auditor also has to check that conversion of the gaps have taken place properly. Auditor has to check that deferred tax assets and deferred tax liabilities are calculated properly. Auditor also has to check that equity movements attributable towards minority interest and non-controlling interest is done. Are you getting the point? And what are the other procedures auditor has to follow? In the other procedures, make sure that auditor has to ensure that he should get a good understanding of the management procedures to reduce his risk. Because until unless you will not understand the management procedure, you will not be able to understand it properly. He has to check that goodwill shall be valued at the date of acquisition. The goodwill shall be valued from on the date of acquisition, not on the date of balance sheet, plus be tested for impairment loss at every balance sheet date. We all know that goodwill is required to go for an impairment loss, or at every balance sheet date we have to check that whether there is any impairment loss in the goodwill or not. So it is to be valued on the acquisition date and checked for impairment loss at every balance sheet. And most importantly, financial statements shall be drawn up to the same financial statements of the parent. I already told you, if the financial year of the component is using the different financial year from its parent, then the financial year of the component has to be changed according to the parent. Parent need not change according to the component. But let me tell you one thing, if the companies are following accounting standard, this adjustment you can only do when the difference between the parent and the component is 6 months. If the difference between the financial year of the parent and the component is 6 months and the company is following accounting standards, it is allowed. If the difference between the parent's financial year and the component's financial year is maximum 3 months, then only allowed if the company is following INDS. So it means accounting standard based companies. Accounting standard based companies are only and only going to allow you when accounting standard based companies are only and only going to allow when the difference between the parent and the components, what parents and components financial year is maximum 6 months difference, and it is allowed in case of INDS if the difference between the parents financial year and the components financial year is maximum 3 months. I hope all of you understood the same. Yes. Now, informations to be disclosed in the consolidated financial statement. Remember one thing, auditor shall check that following information shall be disclosed in the consolidated financial statement: amount of net profit, amount of net assets, amount of other comprehensive income. Repeat, amount of net profit, amount of net share in the profits, net share in the assets, and net share in the other comprehensive income of each and every component. Along with that, their percentage towards the consolidated percentage, means percentage of their net participation in the assets to the consolidated assets, percentage of their net share in the profits to the consolidated profit, percentage of their net comprehensive income to the consolidated income. These are the three things required to be shown. With that, your provisions relating to audit of consolidated financial statement is over, everyone. So this is how you have to revise the consolidated financial statement. The notes have already been provided to you. It is being given to the management. Make sure that you are taking the notes link from the management, and make sure that you are going through the videos at a normal pace only, because these are videos for 1 hour for almost each and every particular chapter, and I hope I'm justifying your expectations in making you revise the whole audit. So thank you so much everyone for lending your patient ears. I'll borrow it again in the next video. So see you guys in the next video relating to professional ethics. So bye everyone, take care, bye bye.